Now, without any further delay, let's begin today's event, and I'd like to introduce your moderator for today's presentation. That is Jeff Joseph, CEO of Alpha Pages. Jeff, you have the floor.
Thank you, Phil. On behalf of Fin Alternatives, I'd like to welcome you all to today's call. As a former principal of 2 different venture capital funds, the subject of how to effectively employ capital from IRAs and qualified retirement accounts has always been of particular interest to me as well. So I'd like to go ahead and introduce our speaker for today's session, which is Chris Orr. It's my pleasure to introduce Chris, who's the Director of Institutional Product for PENSCO. Chris is a private equity specialist who began his career with PENSCO on the asset review team. And of equal importance, he's a former financial advisor with Ameriprise Financial as well. So Chris, it's all yours.
Thank you very much, Jeff, and thank you, Phil. I'd like to thank everyone for being here, and good afternoon. So I'm just going to give you a brief overview about PENSCO and then do a little housekeeping, and then we will jump into the presentation here. So a little bit about PENSCO Trust, just so you know, we've been helping investors make alternative investments in their retirement accounts since 1989. We have about 45,000 clients currently and a little over $10 billion under custody with about 40,000 unique asset types. Aside from having the 45,000 individual accounts clients, our other clients expand out to sponsors, fundraisers, registered investment advisors, attorneys, kind of a network of people that are actually our clients aside from the 45,000 unique individual accounts we have. Now just to do a little bit of housecleaning, we'll do a disclaimer here. So the information presented is for educational purposes only, not intended as and may not be relied upon as tax, legal, investment, or other advice. PENSCO performs the duties of a custodian and as such does not evaluate, recommend, or endorse any investment opportunities. Advised to consult your professional advisor for specific guidance regarding your investments. Investments are not FDIC insured, and are subject to risk, including the loss of principal. So, with that being said, let's jump into the benefits of self-directed IRAs for raising capital. So, as I'm sure you all know, and I'll just go over this briefly because we have a well-educated audience today, but just comparing some basic options and features for what we do here at PENSCO. Obviously, we have the traditional Roth IRA. We also do SEP, custody only, solo K accounts. All of these obviously have their tax benefits and their different strategies depending on your investors and or if you're an individual investor yourself. You want to think about the tax benefits that you could be getting from these types of accounts. Obviously, there's stuff to think about as far as distribution ages, what you can do for earnings, and things along this nature for having these types of accounts. But again, we want to provide anything from traditional SEP, Roth, custody only, solo K. All of these can be a self-directed IRA. We often get questions when someone will say, yes, I'd like to open up an account. Can my traditional be self-directed? Can my Roth be self-directed? Every account that PENSCO holds, all 45,000 of them, are indeed self-directed IRAs. We don't have any accounts here that are non-self-directed. There's no fiduciary. We don't have any advisors here. So all of these accounts have clients that are trying to do their own thing and trying to invest in things that aren't necessarily on the market. Obviously, you can always roll over a 401k as well. That's pretty big these days. People change jobs, move from firm to firm, and they have these 401ks that are sitting there in their old company pension and aren't really doing what they want it to. So you can roll over a 401k to a PENSCO IRA, take control, invest in what you know and love. There is new IRS provisions these days where you can only do one rollover a year. So it's very important to consult your CPA, your tax advisor, about doing the rollover and when to do that, as you don't want to get subject to any distribution taxes for doing more than one rollover. So again, just some basic stuff here as far as if you have the ability to use an IRA and to fund it properly, the advantages of doing this in a tax-deferred account or tax-free account is obviously immense, especially if you're having an investment that does have a good return. It only makes sense to do these things in a tax-qualified account. It's also a great diversification play, and it's also nice to take control of what you're doing. Here's a little chart just to show how the tax benefits work and how the growth would work in one of the accounts. Again, I assume that most of you know this, but just want to kind of go over the basic stuff. Again, what we do here at PENSCO is make it possible for folks to invest in things that are not market traded. So private equity and real estate are the basic examples that most people get. So with us, you can have your self-directed IRA, invest in any of those things, but also hold traditional assets at the same time. So if you did want to keep some mutual funds, or if you had some stock that you did enjoy and didn't want to liquidate when you were moving your account over, that's totally fine. You can hold anything here, a market traded, mutual fund, and the alternatives. Basically, we tell people to invest in what they know and what they love. Almost anything can be held in a PENSCO account. There are some specific things that are not allowed in qualified accounts, and I'll get into that a little bit later. But basically what you want to think of is if there is an opportunity, if you have an opportunity to make this great investment, and your big wirehouse says, no, you can't hold that in an IRA, what they mean is you can't hold that in their IRA. It can be held in an IRA most likely, unless it's one of the specific things we'll get into later. So again, PENSCO wants to make it possible to give you greater flexibility to hold those traditional and alternative assets. So a little bit about the marketplace right now. There is about $7.3 trillion in qualified accounts. And now this is IRAs, 401ks, pensions, all of them together. And that is a huge amount of money. And it's increasing every year. From 2009, we are seeing about a 12.5% increase per year on people putting away retirement money. So the message is getting out. Everyone's saving. I think everyone knows that as our average age goes up and up and up, people need to save more and more to be sure that they can retire. So people are putting retirement money away as best they can. About 2% of that $7.3 trillion is actually held in self-directed IRAs. There are many self-directed IRA custodians out there. PENSCO is just one of them, but that accounts for about $146 billion in self-directed IRAs, which is just a huge amount of money. And this money could be a nice pool of income when you're out there raising capital. And it's always good to think about having this extra source of capital out there when you're out there raising. So with that being said, let's get into some of the details here about capital raising with a self-directed IRA. So first of all, let's talk about what kind of things that we actually hold here, what kind of entities we see as far as the private equity is concerned. So we do see LLCs a lot of limited partnerships, common stock, hedge funds, non-exchange traded, convertible notes. We also have secured notes, promissory notes, rights and warrants, minimal rights, single member LLCs, physical real estate. There's all sorts of things. I mean, if we wanted to get into the weeds of it, and I try to stay away from these examples, but just to kind of show you how vast this area can be, you know, we have clients here with farmland, fishing rights, like I said, mineral rights. So the options are out there. We've had plenty of startups be funded through these accounts, all kinds of things happening. So if it's an option and you're thinking about it, it's definitely worth inquiring whether or not it can be held in a self-directed IRA. The answer is most likely yes, depending on a couple prohibited transactions, and again, we'll get into that shortly. So building your business, what we mean by this is, again, all retirement accounts can be self-directed if you roll over to the right place. Why this is good for people raising capital, there's a couple advantages. First of all, you have a much longer term time horizon for these investments. So if you have an investment or a fund that's going to take a longer time, this is a perfect place for it. People can't take their retirement account out, or their money out of their account, until they're 59 and a half, or they have to pay the penalties and early distribution tax, things like that. So if you do have something that has a longer time horizon, an IRA is a perfect place for it because it has to stay in there anyways. You're not going to try to do investments that are looking for a quick 1 year in and out with a percentage rate. Although, again, that could be fine if you plan on reinvesting into the next fund or making their next move. But the idea here is if you do have something that has a long time horizon, an IRA account's the perfect place for it. Again, loyalty of the investors. If you do have a fund that's a little faster and it's a couple years to a year long and you're getting a great return, absolutely they're going to reinvest. If they're getting 8% or whatever it may be, that is an example. If they're getting that return and they have to keep reinvesting in this account anyways, you're going to get the loyalty of your investors. They're going to repurchase, they're going to reinvest, they're going to go into the next fund. And again, they're almost forced to unless they want to go back to the normal market. But if they're getting the return they want and they like the investment strategy, why would they? So it's a good way to get some loyal investors. And then again, additional sources of capital. Doing a raise and you have the trying to fund that last bit, gone out on the taxable side, you've maxed out everyone that you have, why not ask if they'd like to double down in their retirement account? It's an investment that they're already comfortable with. It's an investment that they've already made, an investment that's proved returns. Why not ask if they'd like to get a little bit of that in a tax-sheltered account? It's a nice way to fill out the end of a round if you need to do that. Again, $146 billion out there in self-directed IRAs looking for that next investment. So this is just more of a due diligence. We tell all our clients to do their due diligence when they're making their investments. Invest in something that you know, get into something that you're comfortable with. So this, and just for the sake of clarity, is PENSCO Trust is a custodian. There are several custodians out there. There are also self-directed administrators and facilitators. So we just want everyone to know the difference and what it is that each one of these roles plays. We obviously feel that a custodian is the best place, but we want people to make their own judgment calls and do their own research. And so this is a nice little cheat sheet to just see the difference between a custodian, administrator, and facilitator. Then when you're looking at choosing a custodian or whatever it may be, you jump on your Better Business Bureau, you see who's good, you do your research, and it's just about education for us. We find that most of the times people get really excited. They say, oh, wow, I didn't even know that this was possible. I didn't know that we could do this. So for PENSCO, we want to make it more about the self-directed IRA community in general, building that awareness, letting people know what they can do, and then letting them make their own informed decision on who they'd like to use. So again, this is just a little bit more about us and how we make things possible and what we do. So for fundraisers, asset sponsors, essentially we want to perform an administrative review. And what this means is we're looking for administrative feasibility per the IRS. Can this be held in an IRA account? Are all the documents in good order? We want to get you on our platform, create a QSIP, make sure that everything's good to go. We'll say, yes, you've got the green light. The company looks good. All the documents are in good order. Go ahead and start bringing in investors for funding. So that's on the fund side. For the client side and the client experience, we do have a premier service team. They get all the online tools that they need to monitor their account. We do a welcome call every time they open an account, get them set up online, get their system preferences in there, and try to make it as seamless as possible for everyone who's going to be using a PENSCO account to do these types of investments. Traditionally, this industry has been kind of a pain in the butt, very paper intensive. These are the things we're trying to alleviate here after 25 years of getting it right and trying to find the best way to do it. So this alludes to a little bit of what I was talking about. We're trying to get this automated to the point where it's paperless, and we're very close. Some people still prefer the paper method, and that's fine. That'll always be an option. But we want to make it as fast and easy and as accommodating as possible to get an account opened, to get an account funded, and to get an account to make an investment. And so that's what we're providing right now. We do have a online wizard these days where you can open and fund an account in about 5 minutes, or at least get the funding request. ACAT will go out and that's typically T+3 to get the account funded. Once the account is open and funded, then it's time to make the investment. Again, we do have paperless systems, e-signatures, things like this to make this a little easier for everybody and skip the traditional 40-page application from 10 years ago. So, some rules of the road, like I alluded to earlier, I'm going to get into some prohibited transactions here. So, prohibited transactions are what the IRS deems to be prohibited. There are some things that can jeopardize your account if the IRS decides to come looking into you or do an audit and they find a prohibited transaction, what we call a PT. It could result in a distribution of the account, a full account closure, penalties, all these kind of things. So this is the stuff we absolutely want to avoid while doing this. And there's several things out there, and we'll get into it. If you really want to get some specific details, the IRS code is 4975. That has all the details and all the specifics of the stuff that we're about to get into. So the first one that we see a lot, or that people try to do a lot, and we have to politely say, no, you can't do that, is self-dealing. And self-dealing basically is your IRA account is a separate entity from yourself. So you can't allow yourself to benefit from what your IRA is doing. An example of this is below, and it would say, I'll use a different one actually just for a little more clarity. If you had a house and you wanted to buy a piece of real estate in your IRA, you wouldn't be able to buy your own house from you. So your IRA couldn't buy the house from yourself. That's self-dealing. Same thing for a private equity example would be if you were invested in the fund, you had the fund in your IRA, and you're also on the board of the directors, at the end of the quarter, bonuses come around, and for being on the board and for giving such good information all year, you're going to get a bonus as a board member. That IRA is not receiving that bonus. The IRA is not on the board. You personally are on the board. So no self-dealing. Or another way to put it is no sweat equity either. Next that we see is no mixing. And what I mean by this is if an investment is made through the IRA, it has to stay through the IRA in its entirety. So an example would be if you had a $100,000 capital commitment and you funded the first $50,000 through the IRA, you get a $10,000 cap call, and the client pays for that cap call by writing you a check. That's mixing. He's mixing personal funds with the IRA funds. So once an IRA is invested, all costs and benefits of that investment have to flow through the IRA. So all dividends are getting sent back to the IRA, not to the point-end client. All expenses, cap calls, whatever it may be, coming out of the IRA, not coming out of the client's personal checkbook. Another, to relate this to a real estate example, would be buy a house with your IRA and you do the remodel with your personal funds. Can't do that. That is the mixing of two buckets. Another one is the 25% rule. So this is a good one for all the fund managers out there. You can collect up to 25% or just right under 25% of your fund in qualified dollars. Now, once you hit 25% or above, ERISA rules kick in, and that's what most people want to avoid. So this is a good rule to think about. Again, we can get into more details with the actual IRS code on this, but a general rule of thumb is you're not going to want to raise more than 25% of the total fund with qualified money. So we also have some tax, UBTI, UBIT here. Basically, we always get this. This is kind of one of the scary ones for people that they always ask about. So what is UBIT is unrelated business income tax. UBTI is unrelated business taxable income, and UDFI is unrelated business financed income. So basically, how would you know if you're subject to UBIT? So there's two scenarios that trigger unrelated business income tax for retirement accounts. The first is profits generated from a business or a trade. So when an IRA or a 401k divers profit from an operating business that has not paid business tax on those profits before distributing, the retirement account, that's what's taxed, and that's used at the trust rates. So essentially, you can pay the taxes beforehand, before sending that distribution, That'll avoid any of that. Now, if you send the distribution before doing the business tax, that's what kicks it in. For UBIT, again, this is not a penalty. It's simply a tax on the account. So this is if you were to do this with the IRS, you calculate this by filling out a 990T. PENSCO's stance on this, or any self-directed IRA account stance on this, really is PENSCO's not going to calculate the UBIT or UBTI. It's up to the sponsor to do that. Now, once you inform PENSCO or any other self-directed IRA and the client that there is UBIT, then the tax that gets paid does have to come out of the account, and this goes back to the no mixing rule that we just had. So if there is any UBIT or any UBTI, the account has to pay that tax, and the sponsor or manager, whoever it may be, has to calculate that tax and let the client and the custodian know what needs to be paid, at which point that custodian can cut the check or send the wire to the IRS. So with that being said, that's an overview of everything. At this point, we are going to open it up to a little Q&A with Jeff and I, and then at that point, we will open it up to the questions that have been coming in through the portal that you guys have there. There are a lot of people on, so we'll try to get to all the questions that we can. For those questions that we don't get to, we will try to answer online. I'll also put up a slide here shortly that will have a contact us section. If you have specific questions that didn't get answered, you can send those questions to there, and I'll put that up in a second, and we'll answer the questions offline for you.
Okay. Well, thank you, Chris. Sorry, I was a little distracted. I was on the phone trying to get my house back out of my IRA. But I've got a number of questions here that have come in, but there seems to be a majority of interest on, before I get to a couple questions I have, there seems to be a significant interest on the distinction between UBTI and UBIT. Could you say a little more about that?
Sure. So again, UBTI is unrelated business taxable income. UBIT is unrelated business income tax. And then the third one is UDFI, unrelated debt finance income. So in all three cases, again, the issuer, sponsor, manager is going to let us know what that tax is and what's owed. At this point, we will pay that tax through the IRA account. But again, just to walk through the differences, UBIT, again, the two scenarios that get this generated. First is the example that I went over earlier where there's an operating business that has not paid business tax on those profits before sending distributions to the retirement account. The second way, actually, and I didn't talk about this, is leveraged real estate investments. So when an IRA purchases real estate using non-recourse mortgage loans, the debt finance portion of the property is subject to unrelated business income tax. So similarly, if the IRA owned property and it's sold while the percentage of ownership is still debt financed, profits derived from the debt financing percentage is subject to unrelated business income tax. So that's UBIT. So next we'll go into UBTI, and sorry, I know it gets a little confusing with all the acronyms here. Again, it's going to be the same issue where if you're generating profits before distributing or generating profits before taxing and distributing those, that's what needs to be paid back. So again, it's a simple 990T. You send that to your custodian, and they'll get that taken care of. So when an IRA is, doing ongoing business, tax on the business has to occur. The tax can be taken at the company level before profits are paid to the IRA. In this case, UBIT would not occur, or if the company can pay profits of the IRA before business tax, at which point the IRA would be subject to UBIT. So again, I know that's a lot. If you have more specific questions from the audience, we'll take those offline, but that's the general overview of UBIT.
Okay, thanks, Chris. And about how long does it take overall to complete the entire transaction?
Okay, so there's a couple different ways. If an account is already open and funded and the investment transaction can be completed in about 2 days. This, of course, assumes that the investment has been pre-reviewed with us and is already on the platform. If the asset comes in brand new, It can take up to a week if the documents don't come in good order, and we have to do a little back and forth with the client or the sponsor to get all the documents that we need to perform the review. However, if all the docs come in good order, we can get the review done in a couple days as well. But essentially, the ideal situation is you've got your asset pre-reviewed, account gets open and funded in about 2 to 3 days. Once the funds hit, we'll get that out there with as little friction as possible to make the investment. So if you have pre-reviewed, about 3 days. If we need to do the review on the spot, it can take about a week.
If the client is the bottleneck, how is the issuer notified so he can assist in that process?
Sure, that's a great question. And there's a couple ways. It depends. If we get the issuer's information from the client right off, we're always going to go to the issuer first. We want to kind of alleviate the client of the duties of gathering, an operating memorandum or Secretary of State filings or whatever it may be. Most of these things the clients aren't going to have anyways. So we do have a notification form which every managing member or primary partner or whoever it may be is the contact person at said investment has to fill out to give us their contact information. So we'll try to always go to the issuer and leave the client out of it as much as possible. Some clients are more hands-on than others, so it just kind of depends on how they want to do it, but we're always going to try to let the client do their own thing and just work directly with the issuer.
So the bulk of the communication is then with the issuer and the fund manager. So is that communication back and forth predominantly electronic or by phone? What's that user experience like or interaction between the issuer and you?
Depends on what they like. Most likely we'll send some emails first. We do have a deal desk here, a review team that does go through all these deals one at a time. So we'll always send an email out. We'll give a call as well. Depends on what best practices we get from that issuer. We've seen most of it's electronic. That way people can just reply to their emails, anywhere from their phone to their desk, whatever it may be. Of course, we have live people. We have real people, so you can jump on the phone at any time if you need to work out some details. But we do try to make all the documents, we don't want anyone mailing anything. We're trying to skip all that. So all of that comes electronically. PDFs, e-signatures, everything is fine. So that's what we're trying to do for investment funds.
And the same then with the client-facing side. Is that interaction predominantly through email or by phone?
So again, the client experience we're trying to make as seamless as possible, and it depends. Every client does get a welcome call saying, hey, we received your account application, we got your transfer request out, here's your account number. Let me walk you through registering yourself online so you do have online access. You can see your account live, see what's going on, transactions, documents. So they'll always get at least one call. After that, they can actually pick their own communication preferences. So whether contacted via email or via phone, best way to reach them, we put all that into the client's hands. For those who actually don't want to be contacted at all, we do have a place where they can upload their own documents and just drag and drop things that go straight to our review team. So essentially, if they're so inclined, they can use the technology to their advantage and not have to be on the phone at all. But again, we're going to leave the options up to the clients, however they like best to be contacted.
A question about special documentation in terms of what might be required for IRA funds outside of the norm or any special docs.
Sure. So most of the docs are going to be pretty straightforward. They're all documents that everyone already has. I'll give a couple examples of this. So for, let's just say, corporate stock, for a private corporate stock, for example, we're going to need certificate of incorporation, the offering memorandum, the bylaws, the subscription agreement, if there is one. This is all pretty straightforward. For an LLC, again, an operating agreement, an offering, a certificate, articles of organization. These are all things that everybody has to be a legal entity, right? So it's all there. The things that might be a little specialized and the things to consider are when you're making these investments or when you're prepping for these investments and you're getting a subscription agreement ready. So for example, Chris or the individual isn't going to be the purchaser on a subscription agreement. Instead, it's going to be PENSCO Trust Company for the benefit of Chris Orr's IRA. So there are some specific vesting things you want to keep in mind. Also, when filling out a subscription agreement or whatever it may be, a questionnaire, Chris or the individual is not, again, the buyer, so my Social Security number is not going to go on there. Instead, it's going to be your custodian's tax ID number because it's actually the entity that's buying these investments for the benefit of their clients. So not necessarily any special documentation, but definitely some things to remember when going through the process. It's always a learning curve. The first time may take something. Our review team always will catch those, make sure they're vested correctly, get the right addresses on there, all that kind of stuff. So that's some stuff to think about.
And this is a great question, actually. What about employees' participation? There are funds that certainly seek to have their employees participate for IRA funds. And anything particular or specific about in the way of additional requirements there?
Yeah, absolutely. That is a fantastic question. And we do see a lot of employee participation. Essentially what you want to do when you're drafting the documents, and this is just kind of a best practice, is you want to have an employee participation section which outlines the rules. And of course, when you're having your legal team draft these things up, they're going to know the rules about prohibited transactions and disqualified parties, sweat equity, when they are investing in these. So it's always best to have something in the subscription or operating agreement that addresses employee participation. Again, that's not 100% required. It always helps with the review process. What we do see sometimes is when there is no specific employee addressing part of the sub or operating agreement, is we will get side letters from, someone at the company saying, yes, Chris Orr does work and does manage this fund. However, his IRA will be investing. He will in no way be receiving any additional perks or funds for his IRA's investment. So there are ways to get around it if you don't have the language in there already, but it does require an additional side letter if it's not there. That's a great question, though.
Right. And along those same lines, what about non-accredited investors?
Okay. So again, we leave this completely up to the funds themselves. PENSCO will not tell a fund who they can and cannot allow to invest. This is totally up to the issuer. However, generally speaking, if you are accepting non-accredited investors, your disclosure documents that you generate are going to be essentially the same as those used in registered offerings. So if you are going to have non-accredited investors, which is totally up to you and you can do, you just want to make sure that your team knows that you're doing that. All the proper disclosures are in the review material to make sure that this information is all available to non-accredited investors.
Okay, and I have a number of more questions that have come in, so I'll keep on going. This one specifically, how do I get my fund in front of your clients?
Oh, that's a fantastic question, and this is a question I get every day, actually. And the short answer is PENSCO is a non-fiduciary, so we don't recommend any investment. So we actually cannot put your specific deal in front of our 45,000 clients. What we can do to make your life easier to raise these capitals is to get your deal pre-approved or pre-reviewed, I should say, with us. That way, when you're out there on the campaign trail and you're raising these funds, you already have the option of making this available in an IRA. Again, you might have clients that want to double down. You might have clients that don't have the capital in their checking account currently, but they'd love to use their IRA, whatever it may be. We want to make it possible so you can use IRA as part of your strategy in capital raising, but we can't actually put your fund in front of all our clients. We're non-fiduciary. The SEC would not be pleased with us if we did that. So we'll leave it up to you to use that as a strategy, but we'll make it as easy as possible for you to do.
Okay. And can people invest in other asset types, such as market-traded securities?
Yeah, absolutely. So again, most people think of a self-directed IRA as specifically only doing non-market traded investments, but you can absolutely hold any market-traded security here, mutual funds, common stock, whatever it may be. That's definitely all an option. So you can have a mixed portfolio and have a self-directed IRA be your one and only account, or if you're just using the PENSCO account or any self-directed IRA account for the diversification play and you just have one or two investments in there that are private equity or whatever it may be, that's also fine. totally up to the investor. Sometimes they want to leave the market-traded stuff with their brokers. Sometimes they just want to have one account to have one statement. But yes, you can hold market-traded securities here.
But the most common equity structures or entity structures?
Yeah, absolutely. So again, we're seeing a lot of LLCs, LPs, private common stock, preferred stock, and then you start getting into more, options, rights, warrants, private hedge funds, non-exchange traded REITs, and then of course on the other side of things, off the private equity, we have lots of real estate, lots of secured notes, promissory convertible notes, and then also the less common stuff that I explained earlier, such as, just to give you some random examples, avocado orchards or fishing rights or whatever it may be. But the most common things we're seeing on the private equity side, LLCs, LPs, private, common, preferred, and then the non-exchange traded REITs and hedge funds.
So what about capital calls?
Another very good question. So again, you want to make sure you're doing your non-mixing. So if you have a capital call come in, it has to come in through the IRA. We get these all the time. People commit for XYZ amount. They fund half of it. The rest is a drawdown structure. We will fund each capital call. We just need to receive a copy of the call, and we'll wire the money out to wherever it needs to go. In addition to that, we also see additional fundings. An additional funding that isn't a cap call requires a new subscription agreement, while capital calls, if you've already committed to $100,000 and you haven't funded that full amount, all we need to do is receive a copy of that cap call because we know the committed amount. Now, if you've reached your committed amount and now you're making an additional investment, that's going to require a new subscription agreement. But capital calls and drawdown structures definitely something that we deal with every day.
Okay. George is asking if can an investor invest directly into a fund from their IRA account?
Can an investor
invest directly into a fund from their IRA account?
Yeah, again, absolutely. Of course, we're going to make that investment as PENSCO on behalf of George. So while George's account will own it, we'll have that line item in their account, PENSCO will facilitate that request. So yes, so long as we have said investment reviewed and it's got the green light from our deal team and the IRS isn't going to come knocking on George's door later, absolutely we can get you into pretty much any direct investment that way.
Okay. And what do you do about non-liquid accounts and RMDs?
That is a great question. The first thing I'll say is that an RMD can be taken out of any IRA. It doesn't necessarily have to come out of the IRA that calculated the RMD. So for example, if you had, one private fund in your PENSCO account and you had an RMD of, $25,000, you could take that RMD out of your Schwab, Merrill, TD Ameritrade account, and that would satisfy the requirement. However, if you are completely illiquid and all you have is the fund in the account, we can always do a partial in-kind distribution where we will distribute a percentage of that fund into the client's name personally out of the retirement account into the client's name. That will satisfy any RMD if you do have non-liquidity.
Okay. One second. Let's see. Okay. What are some of the characteristics of people who use qualified accounts to make these investments? So in other words, what does the average age, average account size look like?
Yeah, absolutely. So while we do have a wide variety of account holders here, varying from the uber high net worth individual to someone who's fairly young and just creating their account, we are seeing more and more young people or younger people open self-directed IRAs. I think that the education of it is finally starting to take off, and people are realizing that they can take more control of their own destinies in that regard. But our average account size out of the 10+ billion that we have is about 175K, and our average account age is probably around 60 years old. So while it is about a 60-year-old average account, again, more and more younger accounts are being opened up, so we'll probably see that dip down a little bit here shortly. But on the average, it's about 60, and it's about $175,000.
So typically, is the issuer identifying or creating a relationship with the custodian, like PENSCO, or does the client initiate the search for the custodian?
It can come in both ways. Obviously, an issuer isn't going to tell a client, you can only use this one specific custodian, right? No one's going to say that. So if a client has someone that they want to use, by all means. And we're fine with that. We have clients bringing deals to us all the time. However, what we've been seeing and what we find is the best practice is if that issuer initiates that contact first before clients come in, it really makes the experience that much better for the point-end client. So if your fund's already pre-reviewed and pre-accepted and ready to go, that way the client comes in, they get an account open and funded. They don't have to do any back and forth with document gathering. We don't have to go through that whole song and dance, and we can get the investment done in a couple days. So as a best practice, I would always say it's great for the issuer/sponsor to reach out to the custodian to kind of get that legwork out of the way and just make things as seamless as possible for their clients.
Okay, I see two more questions at this moment. Sure. What is the issuer, sponsor, manager's responsibility after the funding?
That's a very good question. So there are a couple things that have to happen after funding. Number one, we have to get a confirmation. So we'll send you a confirmation request saying, did you receive, X amount of dollars for X amount of shares in X fund? That has to happen. We need that confirmation back so we know that the money is going to the right place. Obviously, we're being instructed where to send it, so it's just a double check, but the IRS wants to see that. Secondly, the sponsor, manager, whoever it may be, is required by the IRS to at least make one annual valuation. So you can do it once a year. That's the IRS required minimum to give us a valuation update. It can be the exact same value because a lot of these things don't move for several years. So there's nothing wrong with having the same value as long as we get an update. That being said, another question I get is, okay, you have an annual valuation. Could I update it more? Absolutely. You could send us a statement every week if you wanted to, and we would make the adjustment. But you do have a requirement of doing it at least once annually.
So perhaps an early stage venture capital investment can be held at cost basis until there's a liquidity event or a subsequent valuation from a capital raise?
Exactly correct. That's the perfect example.
Okay. And this last question I have is perhaps one of the most important. It says, does PENSCO perform due diligence in the way of underwriting or minimum criteria for any investment?
That's a fantastic question as well. And the short answer is no, we do not perform due diligence. Again, we are reviewing these investments for administrative feasibility, not for whether or not we think this is a good investment. Again, we're not putting deals in front of anybody. We don't have any fiduciary responsibility. Our clients are bringing their deals to us, asking if it's possible to do this in a tax-qualified account. So we will review on that end, but we're never going to say, we think this is a great investment or we don't think you should do this. We like to tell our clients to invest in what they know and what they love, and we'll leave it up to them to make the appropriate decisions for their investment strategy.
Oh, terrific, Chris. That's what I have in the inbox here. Is there anything you'd like to wrap up with?
I'd just like to say thank you to everyone, and also thank you to you so much for having me. The last screen here, if you guys have any questions that didn't get answered, if you want to learn more, if you want to contact us, here's the information here. We will have PDF slides available of the presentation so that anyone wants to request them. And I'd just like to say thank you so much. If you have anything else, that's great.
No, thank you as well, Chris, on behalf of everyone at the Alpha Pages and particularly Fin Alternatives. We really appreciate your time and the information you've shared with us. Thank you so much.
Absolutely. Thank you so much for having me.